Welcome back, everybody. Today we're doing a deep dive into the psychology of money by Morgan Housel.
Yeah, a really interesting one.
We're going to try to unpack some of the really cool ideas in there.
Right.
So to kind of set the stage, this isn't just a book about the mechanics of money.
Yeah.
It's really about how people think about money.
Yeah, the psychology of it.
Yeah, and how our own personal experiences and biases really shape our financial decisions.
Absolutely. And sometimes those are good.
Right.
And sometimes those are not so good.
Yeah, and the book starts out with a real head scratcher.
Okay.
How could Ronald Reed, a janitor, amass an $8 million fortune,
Wow.
while Richard Fuscone, a Harvard MBA, ends up bankrupt?
Yeah. How does that happen?
Right. What's the secret sauce here?
Yeah. What is that secret ingredient?
Is it just luck, or is there something more to it?
Right.
And, Housel argues that it's often less about technical expertise and more about behavior, patience, and long-term thinking.
It's those soft skills.
Yeah, those soft skills, those are often kind of overlooked.
Yeah, you don't think about that when you think about finance.
Right. You think about, like spreadsheets and,
Complicated formulas.
Yeah, exactly. But it's really about, those habits and those mindsets that can make a real difference.
The consistency.
Yeah, and it's not about, being the smartest person in the room.
Yeah.
But just making smart choices consistently over time.
Yeah, that's a good way to put it.
Kind of like how, small habits can have a huge impact on our health.
Absolutely.
In the long run.
Yeah, little things you do every day.
Right, exactly. And Housel dives into, how our personal histories really shape our financial outlook,
Okay.
From childhood experiences to, major economic events we've lived through.
Right.
For example, someone who lived through the Great Depression might view risk and the stock market
Oh, yeah.
very differently from someone who grew up during a booming economy.
Totally different. Yeah, they've seen totally different things.
And that makes me think about, my grandparents
Right.
who lived through some, really tough times.
Yeah.
They were always so careful with their money.
Mm-hmm.
They saved every penny,
Yeah.
even when things were going wrong.
Right. Makes sense.
It does. Their experiences really taught them the importance of being prepared for the unexpected.
Yeah, absolutely. And it's interesting. There's some economists, Ulrich Melmandier and Stefan Nagel.
Okay.
They actually studied this, and they looked at 50 years of financial data.
Wow.
And they found that people's willingness to take risks is heavily influenced by the economic climate they experienced in their younger years.
So what you see when you're younger really shapes
It really does.
your outlook.
Really impacts your worldview.
Wow, that's interesting.
So basically, your early experiences leave a lasting imprint
Yeah.
on your financial worldview.
So even seasoned investors like Bill Gross,
Oh, yeah, even Bill Gross.
are shaped by this too.
Absolutely.
So he's not immune to
Nope, not at all.
These psychological forces.
He attributes some of his success to just the fortunate timing
Oh, yeah?
of falling interest rates during his career.
Interesting.
Imagine if he had started during a period of rapid inflation.
Right, his whole strategy
Totally different.
would have had to be different.
Totally different, yeah.
It highlights how much of, what we perceive as skill or success
Yeah.
can be influenced by factors beyond our control.
Things we don't even think about.
Yeah. Yeah,
That's a humbling thought.
it is. It's very humbling. Yeah.
It really makes you realize that we don't have as much control as we think,
Yeah.
but we do have some control, right?
Yeah, we do have control over our own.
How we react.
Yeah, how we react to these situations.
Exactly.
How we behave. Speaking of control, Housel talks about this illusion of knowledge
Okay.
when it comes to money.
The illusion of knowledge, yeah.
And this idea that we often overestimate how much we understand about money based on our limited personal experiences.
Absolutely. We build these narratives about how the world works
Yeah.
based on a tiny sliver of reality.
That's like, looking through a keyhole
Yeah.
and thinking you understand the whole room.
That's a good way to put it.
Yeah, right?
We don't see the whole picture.
We don't see the whole picture.
Yeah.
And he uses the example of lottery tickets.
Okay.
They're statistically a terrible investment.
Yeah, I mean, the odds are
Ridiculously slim.
astronomically slim.
Yeah, yet they remain incredibly popular,
Yeah.
especially among, lower income households.
Mm-hmm.
And I know the odds are terrible, but maybe for someone who's always faced financial hardship,
Yeah.
that small chance of winning big
Right.
feels more appealing.
It does.
than the slow, steady grind of saving and investing.
Yeah, it's more tangible in a way.
Yeah,
Yeah.
right. And it's like, their own personal.
It's their risk-reward calculation.
Exactly.
Yeah.
Yeah. And that's the key takeaway here, I think,
What's that?
is that every financial decision
Yeah.
makes sense to the person making it
At that moment.
at that moment, right?
Yeah.
Based on their unique worldview and
Yeah.
experiences.
From their own little keyhole.
Yeah, their own little keyhole.
Exactly.
And we can't judge those decisions based on, what seems rational to us
Right.
without understanding the context
The full context
of where they are
making the choice.
coming from.
Yeah. So it's a good reminder to be, I think, more understanding
Yeah.
and less judgmental.
Have a little empathy.
Yeah. Even when we see
It's
people
not fair.
making what we might consider like,
Yeah, quote unquote bad.
yeah, quote unquote, bad financial decisions.
Right, because it makes sense to them
Right. Yeah.
at that time.
At that time, exactly. We're all products of our experiences.
There you are.
Okay, so let's shift gears a bit and talk about this concept of enough.
Okay, no.
John Bogle, the founder of Vanguard,
Oh, yeah, Jack Bogle.
tells a great story.
Yeah.
About being at a party with Kurt Vonnegut and Joseph Heller.
Two great writers.
Yeah, two great writers.
Love him.
And, a billionaire approaches Heller and says,
Okay.
I have something you'll never have.
Oh, boy.
I made more money in one day than you'll make in your lifetime.
Okay.
And Heller famously replies,
What do you say?
yes, but I have something he will never have. Enough.
Ooh, I like that.
Yeah.
Mic drop moment.
Right. And so it's this idea that
A
enough isn't a specific dollar amount.
Right.
It's a state of mind.
The feeling.
Yeah, like feeling content
Yeah.
with what you have.
Satisfied.
Yeah, satisfied.
I think that's a really hard thing for a lot of people,
It is,
especially in today's world. Yeah.
especially today, yeah, with social media and,
I like to do it too.
keeping up with the Joneses.
Yeah, it's hard to tune that out,
Yeah.
but it's so important.
It is, and so it's about aligning your financial goals
Yeah.
with your values
Your values, yeah.
and desired lifestyle.
Yeah. It's about recognizing that more money doesn't automatically equal more happiness.
And thinking about that makes the story of Rajat Gupta,
Okay.
the successful businessman who threw it all away
Oh, yeah.
for insider trading.
Yeah. What was he thinking?
Right.
He had it all.
He seemingly had it all.
He had enough,
Yeah, he had enough, but clearly
but not really.
he didn't feel like he had enough.
Right. And that's, I think, the problem.
Yeah, and it's tragic.
It is
His story is really a cautionary tale,
a reminder.
reminding us that true wealth isn't about accumulating vast sums of money.
Right. It's not about the number.
Right.
It's about having the freedom
That freedom, yeah.
to live a life
That's meaningful to you.
aligns with your values.
Yeah, and for you as someone who, values learning and personal growth,
Mm-hmm.
enough might be about having the resources to pursue your passions.
Right.
To travel.
Yeah.
Or simply to have more time to spend with loved ones.
To have those options.
Yeah, those options to make choices
Right.
based on what truly matters to you.
Yeah, rather than feeling trapped by circumstance.
Yeah, and that brings us to one of the, I think, most fascinating concepts
Okay.
in finance, which is compounding.
Compounding. Yeah.
It's often described as like the eighth wonder of the world.
I've heard that.
Right, but it can feel a bit abstract.
Well, it's hard to grasp.
Hard to grasp, yeah.
It's not intuitive.
Yeah, how do we actually wrap our minds around the power of compounding?
Right. So how do you think about it in like a concrete way?
Yeah, in a concrete way.
Well, one way to think about it is to think about ice ages.
Ice ages, okay.
Yeah. So these massive shifts in Earth's climate,
Yeah,
they're triggered by something called Milankovitch cycles.
okay.
These are subtle changes in Earth's tilt and orbit that cause tiny variations in sunlight reaching the planet.
Okay.
Over the thousands of years,
Yeah.
these seemingly insignificant variations can trigger the formation or the melting of massive ice sheets.
So it's like a snowball effect.
It is a
Yeah.
snowball effect.
Okay, so how does that relate to like my savings account?
Yeah. So just like a tiny bit of extra sunlight can eventually trigger an ice age,
Yeah.
consistent saving and investing,
Mm-hmm.
even if the amount seems small at first,
Yeah.
can lead to a massive accumulation of wealth
Okay.
over the long haul.
So time is the key ingredient here.
Time is the key.
It's not just how much you save.
It's how long you save
It's
to.
how long you save for.
Exactly.
Like
So the earlier you start,
the better
the more time your money has to grow.
to work its magic.
Yeah. Let's look at Warren Buffett.
Okay.
He's famously said that his wealth comes from a combination of American tailwind, and compounding.
Okay.
Now imagine if instead of starting with $1 million,
Okay.
he'd only had $25,000 at age 30.
Okay. So he started later.
Later, even with his exceptional investment skills, missing out on those early years of compounding would have had a dramatic impact on his final wealth.
Like, how much are we talking?
We're talking billions of dollars of difference.
Wow, billion.
Billions.
That's mind-blowing.
It's hard to even fathom.
It is.
Right.
But that really highlights the importance of starting early.
It really does. Yeah, the earlier the better.
But what about those of us who, didn't start investing in our teens or 20s?
Yeah, I think it's never too late to benefit from compounding.
Okay.
Even if you start later in life,
Yeah.
consistent savings and investment will still pay off.
So don't get discouraged.
Don't get discouraged.
If you haven't started yet, just start now.
That's the message. Just start now.
Okay.
Time is your greatest ally when it comes to compounding.
Yeah.
The sooner you get started, the more time your money has to grow exponentially.
This whole conversation about compounding reminds me of
Yeah.
the rapid advancements we see in technology.
Oh, yeah.
How data storage capacity has exploded
Oh, yeah.
over the past few decades. It's
Yeah.
like an almost vertical curve on a graph.
Yeah, that's a great connection.
Yeah.
The exponential nature of compounding is all around us.
Yeah.
It's not just in finance.
Right.
It's in nature.
Yeah.
It's in technology.
Yeah, it's this fundamental force.
It's a fundamental force.
Yeah. It's pretty cool
It is pretty cool.
when you think about it.
It's amazing.
Yeah, and something that we can all harness.
Absolutely. We can all take
Because
advantage of
if
that.
we understand it, and if we, make those...
Make those consistent choices.
Yeah, those consistent choices over time.
That's the key.
Yeah, awesome.
Yeah. It's amazing how that works, right? And speaking of exponential growth, we were talking about Warren Buffett.
Yeah.
Let's talk about Jesse Livermore for a second.
Okay, Jesse Livermore.
He was a legendary stock trader
Okay.
in the early 20th century.
Yeah, I heard of him.
Made and lost multiple fortunes
Oh, wow.
through speculation.
So he knew how to make money, but not necessarily how to keep it.
Yeah, that's a good way to put it.
Yeah.
He understood how to make it in the markets,
Mm-hmm.
but he didn't really get the keeping it part.
Yeah. It's like being a great chef, but having a terrible habit of overeating.
Yeah, like you can create amazing dishes,
Right.
but your health is eventually going to suffer.
Your health is going to suffer. Yeah.
Yeah. So Livermore's story is kind of a cautionary tale.
Okay.
It shows that keeping wealth can be even harder than making it.
Yeah. Because you let your emotions get in the way.
Yeah. You can get greedy.
Right.
You can get scared.
Fear and greed.
And those are the two things that'll really kill you in the market.
Yeah. Yeah. That makes sense.
He was a brilliant trader,
Mm-hmm.
but he lacked the discipline
Okay.
and the emotional control
Yeah.
to navigate that market volatility.
So you got to have a strong mindset.
You got to have a strong mindset.
Yeah.
In contrast to Livermore, think about Warren Buffett,
Right. The tortoise.
the tortoise. Yeah.
Yeah.
He's not known for making, flashy bets or chasing the latest trends.
Right.
His success comes from patience, discipline, and a long-term focus.
Right. Slow and steady wins the race.
Slow and steady wins the race.
Yeah. It's less about hitting home runs every time
Yeah.
and more about avoiding strikeouts.
Absolutely.
Yeah.
He's avoided excessive debt.
Okay.
He's resisted panic selling.
Mm-hmm.
And he's weathered countless market storms.
Yeah. He's seen it all
He's seen it all.
and come out on top.
And he's still there.
Still there. Yeah.
Yeah. So his success is a testament to survival.
Okay.
He understands that staying in the game for the long haul is crucial
Yeah.
for allowing compounding to work its magic.
And that kind of leads us to, I think, another important concept.
Yeah.
Room for error, or what some investors call margin of safety.
Margin of safety. Yeah.
So like having a financial cushion
A buffer
for unexpected events.
for when things go wrong.
Yeah. Which inevitably they do.
Yeah. You never know what's going to happen.
Yeah. But isn't that just being overly cautious?
Well, I don't think so.
Okay.
I think it's about acknowledging that things rarely go exactly according to plan.
Yeah.
Right. It's about building in buffers to protect yourself from those inevitable surprises.
So it's about widening the target, so to speak.
Yeah, widening the target.
Recognizing that life is unpredictable.
Life is going to throw you curveballs.
Right. And planning for those unexpected detours.
Absolutely.
Okay. So how does that play out in real life, though?
Well, one interesting example is the German Panther tank from World War II.
Okay. I've heard of that tank.
Yeah, it was a marvel of engineering,
Mm-hmm.
incredibly powerful and sophisticated,
Okay.
but it had a surprising vulnerability.
Okay. What's that?
Mice.
Mice!
Like, seriously, how could mice take down a tank?
Well, they would chew through the wiring
Oh, no.
and cause all sorts of malfunctions.
So these tiny little creatures,
These tiny little creatures could disable this
powerful machine.
this powerful killing machine.
Yeah, wow.
Yeah, it just highlights how even the most meticulously crafted plans
Yeah,
can be derailed by seemingly insignificant, unforeseen events.
yeah, that's a great analogy.
Yeah,
And I can see how that applies to personal finance.
right. Because life throws curveballs all the time.
All the time.
Right. And, I have a friend who's a financial planner.
Okay.
He had everything perfectly mapped out.
Good.
Savings, investments, retirement.
The perfect plan.
The perfect plan on a spreadsheet.
Right.
But then, life happened.
Life habit.
Unexpected medical bills, a job layoff, family emergencies.
Right.
It completely threw his plans off track.
Yeah, so all those things you can't predict.
You can't predict them.
And that's why having that room for error
Is so essential.
is so essential.
It gives you the flexibility to adapt and adjust when those unexpected events inevitably pop up.
It's like having a financial shock absorber.
Okay, yeah, I like that.
Yeah.
So room for error isn't about being pessimistic.
No.
It's about being realistic,
Realistic.
acknowledging that things won't always go smoothly,
Yeah.
and building in some wiggle room.
Some wiggle room.
Yeah.
So it's about increasing your odds of survival,
survive.
both financially and in life. It's about recognizing that you're not a spreadsheet.
Right.
You're a human being
Yeah.
with emotions, biases, and experiences
That influence your decisions.
that influence your decisions.
Yeah, speaking of being a human,
Yeah.
I've always heard that being rational is key to making good financial decisions.
Yeah, Mr. Spock.
Yeah, exactly.
Pure logic.
Pure logic.
Yeah.
The Housel seems to challenge that notion a bit.
Yeah, he does a little bit.
He says it's better to be reasonable
Yeah.
than rational. What's the difference?
Well, think about this. Okay, so back in the early 20th century,
Okay.
there was this doctor named Julius Wagner Jareg,
Okay.
and he had this radical idea for treating syphilis.
Okay.
He believed that inducing a fever could actually help fight the disease.
Wait, deliberately giving someone a fever?
Deliberately giving someone a fever.
That seems counterintuitive.
It seems completely irrational.
Yeah,
But it actually worked.
it worked.
He even won a Nobel Prize for his discovery.
Wow. So sometimes what seems illogical on the surface can actually lead to positive outcomes.
It's not always about the pure logic.
Right. So does that mean we should just throw logic out the window?
No, I don't think so.
Okay.
I think it's more about recognizing that
Yeah.
our emotions, biases, and experiences play a role in our decision-making,
Right.
whether we like it or not.
Whether we like it or not.
Yeah.
So striving for perfect rationality can actually backfire.
Yeah, you can get too caught up in
In the numbers.
the numbers in the spreadsheets.
Yeah.
And you lose sight of the bigger picture.
So it's about finding a balance.
A balance, yeah.
Between logic and intuition.
Logic and intuition.
Okay.
Take Harry Markowitz, for example,
Okay, Harry Markowitz.
Nobel laureate who developed modern portfolio theory.
Oh, so this guy knows his stuff.
This guy knows his stuff.
Yeah.
You'd think he'd use some incredibly complex algorithm to manage his own retirement savings, right?
I would assume so. Yeah.
But instead of using a complex formula,
Okay.
he simply split his money evenly between stocks and bonds.
Wow, so he kept it simple.
He kept it simple.
Even though he could have done something really complex?
Yeah, he opted for a simple, reasonable approach
Okay.
that was easy to understand
Yeah.
and stick with over the long term.
So even the brilliant minds behind complex financial theories
Right.
recognize the value of simplicity,
Simplicity.
practicality.
Practicality, yeah.
It's not always about finding the most rational solution,
Yeah,
but about finding what works best for you,
absolutely.
given your individual circumstances
Your circumstances.
and risk tolerance.
Yeah.
Okay, so let's shift gears a bit and talk about this allure of pessimism,
Okay, pessimism.
especially in the world of finance.
Pessimism, yeah,
It seems like it's always popular.
it's always lurking, right?
Yeah. And Housel argues that pessimism often sounds more intelligent
Yeah, it does, doesn't it?
than optimism.
More credible.
Why do you think that is?
Well, I think it's easier to get attention
Okay.
with doom and gloom predictions
Right.
than with a message of cautious optimism.
Yeah, fear sells.
Fear sells.
Right.
It gets those clicks.
Gets the clicks.
Yeah, and I think pessimists often come across as more knowledgeable. Like,
Okay.
they've got some inside scoop
Right.
on how the world really works.
Yeah. The realists.
Yeah, the realists.
The pragmatists.
Yeah, the pragmatists, but it's not always accurate, right?
Right. Yeah. And it's like that saying, if you're right 50% of the time,
Yeah.
but you're really loud about it,
Yeah.
people will think you're a genius.
People will think you're a genius.
Yeah. Think back to the 2008 financial crisis.
Oh, yeah.
From an outsider's perspective,
Mm-hmm.
the underlying economy hadn't fundamentally changed overnight.
Right.
Yet fear and panic
Fear and panic.
led to a massive drop in wealth and confidence.
It's amazing how quickly things can change.
It is. Yeah, it was like
Yeah.
a self-fulfilling prophecy.
Yeah.
People believed the worst case scenario,
Yeah.
and their actions ended up making it a reality.
It's like a snowball effect.
Yeah.
In a negative way.
Right. It reminds me of how a rumor can spread like wildfire,
Oh, yeah.
even if it's completely unfounded.
Totally.
Yeah.
And it's human nature to focus on those negative events.
Right.
Recessions, wars, plane crashes.
Because they happen suddenly and dramatically.
Right, front page news.
Front page news, yeah. And we tend to overlook the slow, steady progress
The boring stuff.
that's happening all around us.
Yeah, all the good stuff.
Right.
It's happening gradually.
It's like we're hardwired to pay more attention to threats
Yeah.
than to opportunities.
We're programmed for survival.
Yeah,
Right?
which is kind of ironic
Yeah, it is.
because over the long run, things have generally gotten better for humanity.
Yeah, they have.
Life expectancy is up, poverty is down, technology continues to advance.
Yeah, we're living in the best time to be alive
We are, yeah.
in many ways.
In many ways, yeah.
But we don't always see that, right?
We don't always see it.
We focus on the negative.
Yeah, it's crazy.
It's crazy. And, it's interesting. The financial newsletter industry thrives on pessimism,
Yeah.
despite the historical upward trend of the stock market.
It's kind of funny when you think about it.
Yeah, it's ironic.
Yeah, it's very ironic.
Yeah, but that constant focus on potential downsides can have a real cost.
Yeah.
If you're constantly bracing for disaster,
Mm-hmm.
you might miss out on opportunities
Mm-hmm.
or make decisions based on fear
Yeah.
rather than sound reasoning.
So how do we find that balance
Right.
between being aware of the risks
Yeah,
without letting fear paralyze us?
that's the key.
Yeah.
I think it's about recognizing that risk is an inherent part of life,
Mm-hmm.
and especially of investing.
Yeah.
You can't eliminate it entirely,
Right.
but you can manage it.
How do you do that?
Well, by diversifying your investments, having a long-term perspective,
Okay.
and building in that margin of safety
Yeah, that margin of safety,
that we discussed earlier.
that buffer, that cushion.
Yeah, exactly. So the market's going to go up. The market's going to go down.
Yeah, it's going to fluctuate.
It's going to fluctuate.
Yeah.
But if you have that long-term perspective
Mm-hmm.
and you're diversified,
Yeah.
you're not putting all your eggs in one basket.
Right. You're spreading the risk.
You're spreading the risk.
Okay.
You're going to be okay.
You'll be okay.
You'll be okay.
So it's not about avoiding risk, but about understanding it,
Yeah.
managing it, and accepting that it's part of the game.
Part of the game.
Yeah.
It's the price of admission.
The price of admission. I like that.
Yeah.
And that brings us back, I think, to one of the core themes of Housel's book,
Which is
which is this importance of freedom
freedom.
and flexibility.
Flexibility. Yeah.
This idea that true wealth isn't about,
Accumulating vast sums of money.
right, it's not about the number.
It's not about the number.
It's about,
Having the freedom to live life on your own terms
yeah, to make choices
and make choices.
that are meaningful to you.
To spend your time
Right. How you want.
Spend your time how you want with the people you love,
Exactly.
doing the things that you enjoy.
Yeah. So think about your friend, the valet,
No?
who observed those wealthy car owners
Yeah.
and realized that material possessions weren't necessarily bringing them happiness.
Yeah. It was illusion.
It was an illusion.
Yeah.
Right? Or Ronald Reed, the janitor, who lived a modest life
Yeah.
while quietly building his fortune.
Yeah. He understood
He understood.
what was important.
He understood that true wealth isn't about appearances.
Yeah. It's not about the fancy car
It's not about the fancy car
or the big house.
or the big house.
Yeah.
It's about having the resources
That's for resources.
to pursue the things that truly matter to you.
Yeah. And for many people, that means having control over their time,
Their time,
their options, and their future.
their options, and their future.
Having that security
That security.
to know that you can make choices
Yeah.
based on what you want.
Yeah. Rather than feeling trapped.
Trapped by circumstances. By circumstances.
Yeah.
And achieving that level of freedom
Mm-hmm.
doesn't require a massive income.
Right. You don't have to be a millionaire.
You don't have to be a millionaire.
Yeah.
It's about aligning your spending
Maybe
with your values,
your value.
living below your means,
Yeah.
and developing that discipline to save consistently.
Yeah. Those habits.
Those habits.
Again.
Yeah. So it's about making choices that give you more control
Control.
over your life
Okay.
rather than feeling trapped by circumstances.
Yeah, and my wife and I, we've been fortunate to have rising incomes over the years,
Okay.
but we've made a conscious decision to maintain the lifestyle that we established, early in our relationship.
Yeah, you're not letting lifestyle inflation get you.
Yeah, we're trying to avoid that.
That's smart,
Yeah, it's not always easy.
but it's worth it.
Yeah.
That peace of mind.
The peace of mind is priceless.
Absolutely.
Speaking of prices, Housel points out that investment returns come with a cost.
A cost.
It's not a free lunch.
There's no free lunch.
What does he mean by that?
Well, he's talking about volatility and uncertainty,
Oh,
right?
yeah.
You can't avoid that,
You can't avoid it.
especially if you're seeking those higher returns.
Right. So it's like buying a ticket to Disneyland.
Yeah,
You're paying for a day of fun and excitement.
right.
But you also know there might be long lines,
Crowds.
crowds, maybe even some rain.
Yeah, the churros might be cold.
Yeah.
It happens.
So you're accepting those potential downsides
Yeah.
as part of the experience.
Right.
Yeah.
It's the price of admission.
The price of admission.
Yeah, those market fluctuations are like the fee
Okay.
for accessing those potentially higher returns.
Yeah, you got to pay to play.
You got to pay to play.
Okay.
It's not a punishment for doing something wrong.
Right.
It's simply the price you pay for being in the game.
For being in the game. Okay.
So instead of trying to avoid those ups and downs,
Yeah.
we need to accept them as part of the journey.
Part of the journey.
Trying to time the market
Yeah.
or outsmart volatility
Right.
can backfire.
You can get burned.
You can get burned.
Yeah.
It can lead to higher costs,
Okay.
missed opportunities.
Mm-hmm.
You can end up worse off.
Yeah, you got to be patient.
You got to be patient.
Ride it out.
Ride those waves.
The waves. Okay, so
Yeah.
it's not about avoiding risk, but about
understanding it, managing it, and accepting it
accepting
as part of the game.
part of the game.
It's the price of admission.
The price of admission. I like that.
Yeah.
So how do we distinguish between paying a reasonable fee
Okay.
and getting hit with a fine
Yeah.
for making a bad decision?
That's a good question.
Yeah.
It's about understanding your risk tolerance,
Okay.
your investment goals,
Mm-hmm.
and your time horizon.
So how long you're planning to invest?
How long you're planning to invest.
Okay.
And it's about recognizing that sometimes the biggest fine
Yeah.
is staying on the sidelines
Oh.
and missing out on the potential rewards of participating in the market.
Oh, so inaction can be
Inaction can be costly.
costly. Okay.
Yeah.
Interesting.
Just like anything else in life.
Yeah.
You get what you pay for.
Yeah.
But sometimes the price of inaction
Yeah.
is higher than the price of participation.
That's a good point.
Yeah. And that brings us to another fascinating aspect
Okay.
of the psychology of money.
Okay.
How easily we can be swayed by narratives,
Maps.
especially when those narratives tap into our fears and insecurities.
Okay, so like stories we tell ourselves
Stories we tell ourselves
about money and the economy.
about money and the economy.
Yay.
Yeah. Think back to the aftermath of World War II.
Okay.
There was a massive wave of uncertainty.
Yeah.
Millions of soldiers returning home.
Mm-hmm.
No one knew what the future held.
Yeah. Tough time.
Tough time. Economists were predicting a return to the depths of the Great Depression.
Oh, wow. So a lot of pessimism.
A lot of pessimism, a lot of fear.
Yeah.
But then something remarkable happened.
Okay.
Americans embraced a new narrative,
A new narrative. Okay.
one of optimism, growth, and consumerism.
Okay. So they shifted their mindset.
They shifted their mindset,
Okay.
and that shift in mindset
Yeah.
helped fuel an unprecedented economic boom.
Wow. So a change in the story we told ourselves about the future
Yeah,
actually helped shape the reality we experienced.
absolutely.
That's fascinating.
Yeah, it's powerful stuff.
It is.
The narrative wasn't just a reflection of what was happening.
Yeah.
It was a driving force behind it.
It was a driving force.
Yeah,
That's amazing.
it's amazing.
When you think about it, it makes me think about like the dot-com bubble.
Yeah.
Where people poured money into companies
Yeah,
with no earnings and sky-high valuations.
right.
The narrative of getting rich quick
Getting rich quick, yeah.
was so compelling
It was so seductive.
that many people ignored basic financial principles.
Yeah, they got caught up in the hype.
In the hype.
The fear of missing out.
The FOMO.
The FOMO.
Yeah, exactly.
Yeah, or think about the housing bubble of the mid-2000s.
Oh, yeah.
People believed that home prices could only go up.
Yeah, it was a sure thing.
It was a sure
Well,
thing.
yeah, right.
And that belief, fueled by easy credit and a lack of regulation,
Right.
created this dangerous feedback loop.
That ultimately led to a devastating crash.
Yeah, a lot of people got hurt.
Yeah, so how do we protect ourselves
Right.
from these seductive but potentially dangerous narratives.
Yeah. How do we separate fact from fiction?
Especially when it comes to our finances.
Especially when it comes to our finances.
Yeah.
Yeah, that's the million-dollar question.
It is, yeah.
It requires, I think, a healthy dose of skepticism.
Okay.
A willingness to question assumptions.
Don't just take things at face value.
Don't just take things at face value.
Yeah.
And a commitment to seeking out diverse perspectives.
Okay, so get different viewpoints.
Get different viewpoints.
Okay.
Don't just listen to one person
Yeah.
or one source.
Right, because everyone has their own agenda.
Everyone has their own agenda.
Yeah, and their own biases.
Their own biases.
Yeah, okay.
And, it also means understanding our own biases.
Our own biases, yeah.
Yeah, those mental shortcuts
Yeah.
that can lead us astray
Yeah.
when we're dealing with complex and emotionally charged topics
Yeah.
like money.
Yeah, because money is emotional.
Money's emotional.
Yeah.
Absolutely.
So it's not just about learning about finance. It's about learning about ourselves.
Learning about ourselves.
Our tendencies.
Our tendencies.
And the stories we tell ourselves.
The stories we tell ourselves.
Yeah, about money and the world around us.
Yeah, it's a journey of self-discovery.
It is.
It's lifelong.
Lifelong, yeah.
Yeah, the more we understand our own psychology, the better equipped we'll be to make those sound financial decisions.
Yeah.
Navigate those inevitable ups and downs of the market
Yeah.
and achieve that level of freedom
Yeah.
and flexibility that we truly desire.
That we truly desire. Yeah. It's really interesting, isn't it, how all of this kind of boils down to the fact that it's not enough to just understand the numbers, the mechanics of money.
Right.
You need to understand how people work.
Yeah, especially yourself.
Especially yourself.
I think that's what this book is really all about.
It's like a self-help book for your finances.
It is.
Yeah.
It encourages us to examine, our own financial beliefs, our behaviors. We all have biases, blind spots,
Right.
emotional triggers that influence our decisions.
Often without us even realizing it.
Without us even realizing
Yeah,
it.
but those stories about Ronald Read and Richard Fuscone
Oh, yeah.
really kind of drive that point home.
Yeah, they're great examples.
Yeah, they remind us that financial success isn't always about
Intelligence.
intelligence or formal education.
Right. It's not about what you know.
It's not about what you know.
It's about what you do.
Yeah, it's about how you behave
Exactly.
and about mastering those
Soft skills.
soft skills, patience, discipline, long-term thinking.
Right. Those are the things that
That allow us to stay the course.
allow you to stay the course,
Yeah.
even when our emotions are running high,
When you want to bail out, when you want to panic.
when you want to sell everything.
Yeah, when you want to buy everything.
Yeah, exactly.
It's about having that discipline.
Those soft skills are essential for navigating the ups and downs.
The ups and downs. Yeah, the market's always going to go up. The market's always going to go down.
It's going to be volatile.
It's going to be volatile.
Yeah, and it's about having that perspective
Having that perspective.
to ride it out.
To write it out.
And they help us avoid, the pitfalls of
Impulsive decisions.
impulsive decisions, short-term thinking.
Yeah, shooting yourself in the foot.
Yeah, it's like the difference between simply reacting
Yeah, just knee-jerk reaction.
and responding thoughtfully.
Thinking it through.
Yeah.
Taking a step back.
Okay. Yeah, I like that analogy.
And it ties back to, our earlier discussion about room for error.
Yeah, margin of safety.
Margin of safety. If you have that
That cushion, that buffer.
built into your financial plan,
Yeah.
you're less likely to panic
You're less likely to panic.
and make rash decisions when the market takes a dip.
Exactly.
Yeah.
You're not going to sell everything.
You can weather the storm.
You can weather the storm.
Yeah.
You can ride those waves.
Okay, so you're more likely to just stay calm
Stay calm.
and stick to your long-term strategy.
That's the key.
Okay.
That resilience.
Resilience.
That's the key ingredient,
for achieving the ultimate goal.
which is financial freedom.
Financial freedom.
To live life on your own terms.
To do what you want when you want.
Yeah.
With who you want.
Yeah. And that goal aligns, I think, perfectly with,
Absolutely.
the learner persona.
Yeah, it's about having the resources.
Yeah.
The flexibility.
The flexibility.
To pursue your passions.
Yeah.
Explore new opportunities.
Travel the world. Travel the world.
Or just, spend more time doing the things you love.
The things that matter most.
Yeah.
And, it often requires, I think, a shift in perspective.
Okay.
It's not about chasing the latest get-rich-quick scheme.
Right. No shortcuts.
No shortcuts,
Well,
no magic formula.
Yeah.
It's about developing a deep understanding of yourself,
Yeah.
your values, your goals,
Yeah.
your risk tolerance.
Yeah, it's about knowing yourself.
Knowing yourself.
And aligning your financial decisions with that self-awareness.
With that self-awareness, yeah.
So it's not just about the money.
No.
It's about you.
It's about you. It's about your psychology.
Yeah, it's about your mindset,
Your mindset.
your behaviors,
It-
your
it-
habits.
It's all connected.
It's all connected.
Yeah.
Okay, so our deep dive into the psychology of money has been a journey of exploring not just how money works, but how we work.
How we work.
When it comes to money.
Exactly.
It's been really eye-opening.
Yeah, I hope so.
To say the least.
For sure. So what are some of the key takeaways?
Well, I think, for you as a learner,
Mm-hmm.
the biggest takeaway is this. Financial success is less about what you know and more about how you behave.
How you behave.
It's about mastering those soft skills.
Yeah.
Building in room for error.
Having that margin of safety.
That margin of safety.
Yeah.
And understanding the powerful role that emotions and narratives play.
Absolutely.
In shaping our financial decisions.
Yeah. We're all human.
We're all human.
We all make mistakes.
Yeah.
But if we can understand those biases, those tendencies, we can make better choices.
We can make better choices.
Yeah.
It's about making choices that are aligned with your values.
Your values.
And your vision for the life you want to create.
That's the key.
Yeah, it's about understanding that money is a tool.
Money is a tool.
And like any tool, it can be used wisely or foolishly.
It can be used to build or destroy.
Yeah, to build or destroy. That's a great point.
So here's a final thought.
Okay.
Since our personal experiences shape our financial worldview so strongly, how can we become more aware of our own biases?
That's a great question.
And make more objective decisions?
Yeah. How do we step outside of ourselves?
Right.
And see things more clearly?
And make choices that are truly aligned with what we want.
With what we want and what's important to us.
What's important to us,
Yeah. Those are great questions to reflect on.
Yeah, I hope this has been helpful.
As we continue our journey.
Our journey of learning and growing.
Of learning and growing in this fascinating world of personal finance.
It is fascinating.
It is fascinating.
Absolutely.
And remember, knowledge is power.
Knowledge is power.
Even small changes in our financial habits.
Small changes.
Can have a big impact over time.
Absolutely.
Yeah. Thanks for joining us on this deep dive.
It was a pleasure.